What is going on in the markets right now? When should I be concerned? When should I not be concerned? Listen, everything comes down to the fundamentals. And today we're going to be talking about those fundamentals, the things that you need to be paying most attention to. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
All right, welcome to the show. Listen, I have a lot of information for you today. Every quarter we do what's called a market update. So I just want to share with you a lot of what I would call valuable information on about what's going on out there in the economy, in our markets in general. We've been now 10 years, 3 months into this bull run. It means we've been 10 years, 3 months where we haven't had a greater than 20% correction in the market that's lasted more than 2 months. All right. Now, when times have been good for this long, people are waiting for the shoe to drop, right? So it's causing a lot of people to get nervous, and they're also reacting to any bad news that they see. But this is why we do this. We want to just kind of keep things in perspective. You can look at the market indexes for the first half of this year. The S&P 500 was up 17%, when last year it was down 6%. So it's been a good, first 6 months that we've had. I mean, now most of that was in the first 3 months, making up for that fourth quarter. But to say the least, things have been going good so far in the market. This is just, when you look at the S&P 500 as a whole, you can see that, when we look at it as a whole, it's been doing good. But if you look at this statistic, it shows 40% of the S&P 500 is still down 20%. That means not all 500 stocks are doing well like them as a whole. This is just the chart of the S&P 500 the last 2 years. Folks, if you take a look at this, look how volatile this is. I mean, the fourth quarter 2018, lost almost 20%, only come back in the first quarter. It's been very, very volatile, which is causing a lot of people to get nervous, as I said. Just to let you know, when you have markets that are doing well, it's not uncommon to have periods where they'll have, short-term corrections. Sometimes we call this, getting rid of the weak players, people that just can't take the volatility. They'll get out, they'll kind of drive the market down for a little bit, and then it kind of resumes on its path. So these are normal. We can have these at times. This is just the S&P 500 compared to the world, the rest of the world except us. You can see when you look back over 2 years, there was a period of time when it was tracking with ours almost in tandem, and then there was a separation where ours was doing well, theirs wasn't. Well, now if you look at that now over the last year, pretty much working in tandem. GDP growth, the first estimate that came out here in July for the second quarter is 1.5%. We're seeing some slowdown here. Now, the definition of a recession is where you've had 2 quarters in a row of negative GDP growth. We are start to see some slowing. So this is of a concern. It'd be interesting to see. They did this at the first quarter, same thing, and then when we got the final estimate out, it ended up being much better than they thought. So we'll see where this goes. Unemployment, lowest it's been in 49, 50 years. This has been the good thing about our economy right now is everybody's working, right? And when people are working, they're spending. When they're spending, that's good for the market. This is just civilian labor force participation. You see it was flat or decreasing, and as of recent now, you've seen an uptick in that. So people are jumping back into the workforce, which is also a good thing. This is just new one-family houses sold in the U.S. You can see that it was steadily on the rise since 2008. It was starting to flatten off, which was a concern, but now recent started to see an uptick. I think probably because of the lower interest rates. This is just median sales price of houses sold in the United States, also been on the rise, but of recent been kind of on a flat territory. This is the inflation rate, still holding at about 2%. This has been the big anomaly, and the feds are scratching their heads. When you've had such low unemployment, how come we're not seeing inflation rise? It just hasn't been there. I think recent statistics show that because we got more people working, they're not necessarily making as much as they were, and a lot of technology is kind of keeping that down. Federal Reserve, in the fourth quarter, a lot of negative news. Everybody thought they're going to continue to raise their rates. They've decided to take a more dovish posture now. They're saying not only are we not going to raise rates, we're most likely going to decrease them. Now, the markets reacted very favorably to that, but honestly, it begs the question, if the Feds are looking to drop rates, that means they see something coming, right? Maybe not necessarily now, but something coming, so we want to be paying attention. And I just want to leave this segment with this. This is a chart showing we never really know what the Feds are going to do. This chart shows that you see the solid line is what the Feds did. All those dotted lines is what everybody thought they were going to do. You don't see any commonality there, do you? Basically what it's saying is we don't know what they're going to do, but all the more reason we want to pay attention. So stay tuned. I'm going to come back. I'm going to talk more about these fundamentals. See you then. Guys, one of the reasons we like to do these quarterly market updates is because nothing's more important than giving people a good feel for what's happening and going on in the markets. But I just want to talk a little bit about this idea that we've been in this bull run now for 10 years and 3 months. Now, I know you guys have been just getting started in the financial service industry and you feel comfortable with that and all your training that you got. But I just want to address this because if you're just getting involved in this, somebody that's just take it for somebody that's been around just a little bit longer, right? Markets are cyclical. We'll have periods where they go really well, and we're in what we call expansion mode, and then we enter into a time of contraction. Everything's cyclical. It's really knowing where you're at on it. So when I'm doing these quarterly market updates, I'm doing these, drawing attention to people and the fundamentals. What I'm trying to do really is show them where we're at in the cycle. Now today, most folks are going to look at most of the fundamentals and say, man, things are really good. I would dare say I would agree. We're probably right at the top of this market. This bull run, though, is going to end. And I just want to talk to you guys about that because that's hardly what they teach you, right?
Yeah, just kind of my story getting into this when I was first approached by you to come on board here. I'd been a client for a few years, and they brought me in and said, would you like to do this? Would you like to become an advisor? And my very first response was, I don't know if I can be in the business of losing people's life savings. I don't think I'm way too relational for that. But, as I started going through the training and learning how we structure portfolios and how we can take a defensive posture during this time, then I became way more comfortable with how we're going to approach things that is different.
Yeah, Jack, I appreciate you mentioning that because there's a lot of folks that wonder about that. How do advisors do it, right? I mean, we're holding people's money, and we're making investment decisions for them. And what if the market takes a dive? What are we doing for them? Well, I'm going to tell you, there's two different approaches. There's the advisors out there that basically tell their clients, oh, don't look at your statement, just leave it alone. They adhere to what's called a buy and hold strategy, right? Just that's how they basically tame their clients or train them. Just don't look at your statement, so then they don't have to answer, right, for when markets go bad. But there's another approach, one that we adhere to, which is active management. That's why we're paying attention to market fundamentals. We want to be able to see things before they come, and when they do, react accordingly, right? To me, when 08 happened and the market dropped to half its value, there is plenty of evidence that we were entering into recession and adjustments should be made. But a lot of advisors out there didn't adhere to that. Well, guys, we're going to talk a little bit more when we get back, but stay tuned because I'm going to talk more about these fundamentals and some things we just saw happen this last quarter.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, August 6th at Lakeside Charlie's in Cadillac. Thursday, August 8th at Big Buck Brewery in Gaylord, or Tuesday, August 13th at Stafford's Bayview Inn in Petoskey. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated Financial Decisions. Call 888-608-5825 today.
All right, welcome back. Again, continue with these fundamentals. Now, listen, this is a U.S. wages and salaries growth. You can see it's been fairly flat. Again, with such low unemployment, you would expect this to start being on the rise, and it's not, and it's why inflation's been kept in check. A lot of this is a lot of companies, rather than go out there and hire people or pay more for their labor, they're just finding ways to be more innovative or technological driven, and that's what's kind of keeping a downward pressure on that. So we'll see where that goes. U.S. dollar, since 1973, they've been tracking our currency with the rest of the world currencies, and they baselined that at 100, and then they've been keeping track of it ever since. Right now at 96, basically it's saying that our dollar compared to the rest of the world currency is basically the same as it was back in 1973. So not seeing any downward pressure on this at present. Talked about the Feds. When we got past this last recession, their balance sheet was $1 trillion. In the last 10 years, their balance sheet went up to $4.5 trillion and then down to $3.8 trillion. Basically, they quadrupled their balance sheet or put that kind of money out there in loans. So guess what corporate debt has gone up by since that period of time? Yeah, you guessed it, about the same. So basically, they put all this money in the economy, and the corporations, because of low interest rates, were feasting on that debt, and now it's out there all on these corporate balance sheets. Something that we want to pay very, very close attention to, because all this debt now has got to be refinanced. And when you start to see increases in default rates and things of that nature, it could be the beginning of a bubble burst in that area. Just to show you how corporate debt is rising, all you got to do is look at this chart that points that out. U.S. consumer sentiment, all-time high. I mean, when people are working, they're feeling better about the economy. The market's also held true to that. So, people are feeling good, and that's a good thing in the economy right now, because when people are feeling good, they're willing to spend, and if they're willing to spend, that's good for the markets in general. So that's something we want to pay attention to. Speaking of debt, you can see that household debt since the last recession has actually been on a decrease as a percentage of GDP. So a lot of people learned their lesson from the 2008 crisis and have positioned themselves appropriately this time. But look at the business debt. Hardly has that been the case for business debt. So where maybe we've learned some lessons as consumers on a personal level, we didn't on a business level. And again, that's the thing we're going to want to be paying close attention to. Small business sentiment. Very high, hasn't been this high since 1985. Small business, along with consumers, are feeling good about the economy. And when they're feeling good, they're spending. When they're spending, again, that's good for our market. This is labor costs, again, just trying to show that as unemployment has been going down, labor costs have been on, or wages have been on the rise. For the longest time, that hasn't been the case. Of recent now, we're starting to see an uptick in that. If we continue to see more of an uptick in that, that could mean that wage growth or that inflation that we've been, looking for to happen, but haven't seen necessarily yet. U.S. manufacturing index has dropped considerably. Now, when it's above 50, it's in expansion mode. So we're still in expansion mode, but you can see dipping down quite dramatically. If we start to see that, cross that line below 50 in the contraction mode, going to want to pay attention. This is U.S. non-manufacturing index. Same thing, well in expansion mode, but of recent, just a small decrease. This is the S&P 500, the price to earnings ratio. Folks, you can talk about a lot of the fundamentals. It all boils down to earnings. You know, what are corporations making? The market as a general rule trades at a multiple of its earnings. Historically, that's been around 17 times earnings. And so, you know, the one thing we want to pay attention to, the reason we look at fundamentals is because if we see fundamentals starting to wane, that means corporate earnings are going to wane. That means the market's going to wane. So we want to be well ahead of that. We want to be paying attention. PE ratios have been, for the most part, pretty high for some time. You look at recent, there's been a dip in that. Right now, we're probably trading just a little bit over 17 times earnings, so we're not necessarily in bubble territory, but we certainly don't have a lot of room for the up unless we see earnings on the rise or increase. So again, I'm going to ask you to stay tuned because I've got some more fundamentals to share with you in the last segment. Be right back. Guys, I hope you caught that with the corporate debt situation that we find ourselves in. After the 2008 crisis, you know, the Federal Reserve raised their balance sheet from $1 trillion to $4.5 trillion and then down to, I think it's like $3.8 trillion. But the fact is they put all this money into the economy, and what have corporations been doing with it? Basically raising their own debt levels to levels that we have not ever seen before. This is scary. The reason it's scary, although we've seen that the percentage showed that household debt as a percentage of GDP has actually been going down. The fact is there's a lot of millennials out there with student loan debt. There's just a lot of personal debt out there that you really shouldn't be. And then couple that with corporate debt, and then and then the fact that we've got government debt going out of control. How can our financial system sustain so much debt at such a high level?
Yeah, that's a great point. And realistically, it can't, right? I mean, if it was my household, the first thing that I'm attacking is my debt that I have. So my student loans, my car payments, and my mortgage. So that's right back at you. I mean, what is the government doing, really?
Yeah, Nick, I mean, common sense tells us this, right? I mean, get your own house in order, get control of your debt. You can't just keep printing money, right? You can't keep going out and getting a credit card to pay the interest on the other credit card and expect that not to come to an end at some point. The financial system that we build around, although right now fundamentals are good, economy's doing well, there's a underlying foundation right now that's not the best, and we have to be wary of it because this is not the time, especially coming to the late stages of this bull run. And if we go into recession, I dare say because of all this debt, we're going to feel it a lot harder than we did before. So all the more reason, folks, you want to be paying attention. This is the time that you want to get in, you know, and find out how you're positioned. We have the tools to go behind any portfolio and show you how that portfolio, as you stand today, operated in 2008, so you could see how much risk you're taking on. So encourage you, give us a call. But stay tuned. We got more fundamentals to go through with you.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and I'll also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
We look forward to helping you plan to retire well.
Hi, my name is Jack Klunder, and I'm a financial advisor with Centennial Wealth Advisory. We are now opening an office in the Cadillac area and surrounding cities. So if you have any retirement goals or questions that you'd like to go over, we have a no obligation free consultation. Please feel free to reach out to us, and we'd love to meet with you.
I was talking to you about the last segment and how everything is about earnings, right? Corporate earnings. So this chart is something we want to be paying attention to, and that is, where are corporate earnings? You can see that it's been on the rise for quite some time. But look at this right now, just of recent. We're starting to see just a dip in it. Now, hopefully that's not going to be something that continues because, again, like I said, when the market's trading at a multiple of earnings, when those corporate profits go down, so will the market. This is the U.S. corporate forecast. It still is pointing on an upward trajectory, so still good for the markets because as long as corporate earnings are on the rise, so the market will be as well. This is just the VIX rate, or what we call the volatility index. It's basically just measuring how volatile the market's going to be, good and bad. Usually it's been at about 20, meaning they suspect the market's going to be 20% to the good or 20% to the bad. You can see of recent here it's been down around 15. So that doesn't necessarily mean we have a lot of volatility nor complacency either. So actually a pretty good thing at this point. This is the just Shiller price to earnings ratio. This one goes back, this is one not looking at earnings the past year, it's looking at earnings the past 10 years. And you can see that's been on a decline here of recently, which has been good. It means we're not necessarily in that what I would call bubble territory when it comes to earnings. This is the yield curve. This is the one you've been hearing a lot in the news. When there's been an inversion of the yield curve, there's been a recession maybe 12 months, 18 months out, and it's been incredibly accurate at predicting all the past recessions. But I just want to put this in perspective. When this has been inverted, as you've been hearing in the news of recently, it's actually a different index that they're looking at. It's like the 2-year versus the 3-year. This one, which is 30-year versus 5-year rate, does not show an inversion. As a matter of fact, there's still a difference of 73 basis points, which means it's on a positive trajectory. This is the 10-year versus the 2-year. Actually, close to inversion or flattening, but still 25 basis points off. So the ones most of the analysts pay attention to, which are those two, are not showing an inversion. But when they do, which they could soon, that's going to indicate possibly a recession coming down the road. Not necessarily now, but coming. This is just a share of U.S. income that goes to the top 10% of the people. This is an interesting statistic. We haven't had this since the Great Depression, where you've got less than 10% of the people owning greater than 50% of the wealth. It's probably also why we've got so much social unrest out there, because there's a lot of people, even though the economy has been doing well, they're not necessarily feeling it. The people that are feeling it the most are a smaller class of people. So, it doesn't say we're going to have a Great Depression again. It just indicating that we've had this before. We have it happening actually right now. Sir John Templeton put it very well. He said, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. Most bull runs, folks, don't just fizz out, okay? There's usually, right before they fizz out, there's a euphoria stage where it goes way up and then it goes down. I think we've got things positioned very well right now for we could potentially kind of have that happening. If we get a China trade deal, the Feds do lower rates, and everybody perceives that as a very positive thing. It could drive the markets up, quite considerably. But remember, if earnings are not following that run-up is not going to be sustainable, and there'll be a corresponding correction accordingly. It's all about corporate earnings. Where do I feel like we're at on that gauge right now? I kind of moved the dial to kind of halfway between skepticism and optimism. We're skeptical because we know a recession is coming. We keep hearing, possible trade war concerns. We see the Feds lowering their rates, and you're saying why? That we've heard global growth is slowing down. Eventually that's going to hurt us. So we've got a lot of reason to be skeptical, but we've got some reason to be optimistic too. Unemployment, again, very low. People are working, people are confident, housing's doing well. So when you got a mix of really good news and a mix of really bad news, I dare say we're probably right in the middle. Certainly not in that euphoria stage, not in bubble territory, but all the more reason, folks, and you can't stress this enough, to be paying attention. Now is the time to have your portfolios analyzed, take a look at how you're positioned, see how maybe somebody else is handling things in these market realities we find ourselves in, so you can have the peace of mind of knowing that your money is protected, especially if you're near retirement or in retirement. So again, thank you for joining us today. See you back soon.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, August 6th at Lakeside Charlie's in Cadillac. Thursday, August 8th at Big Buck Brewery in Gaylord, or Tuesday, August 13th at Stafford's Bay View Inn in Petoskey. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
All right, guys, I know I gave our folks a lot of information there, and I had a lot to do in a very short period of time. We actually do this presentation for all our clients every quarter. It's very important for us that our clients are very familiar with what's going on in the markets and where we're at in them, right? So, but you know, you'll notice that today, if I had to summarize everything, there's a lot of good news. I mean, you know, there's a lot of good news that can be found, but there's also some things that are starting to show some signs of slowing down, you know, maybe some early signs that yes, something's coming. It's just a matter of when, and that something coming is recession. We know it's out there. You've heard a lot of talk about it. It's coming. It's just now a matter of when it's going to come. So all the more reason that we want to be paying attention. Now, I want to thank you guys, by the way, for joining me on the TV show today. Jack Klunder, I know you're, just so our folks know, you're operating the Cadillac office, right?
So if you're in the Cadillac, McBain, Lake City area and you want some more individualized help, or if you have any questions, feel free to call and come in for no obligation opportunity.
There you go. And Nick Grieman out of the Gaylord office / Petoskey office, right?
Yeah, definitely. So yeah, if you're looking for that second opinion, please stop in, both Petoskey or Gaylord. I'm here for you.
Okay. And of course, we have our main operations right here in Traverse City, Michigan. So, you know, really, we serve all of northern Michigan. But I just want to stress, and I can't say it enough, this information that you've got today is valuable. It's very important. So take the time now to make sure you're positioned appropriately. Find out from us how we're handling things with the present realities we find ourselves in. We look forward to meeting with you. Thank you.